Hello everybody and welcome to the Cyclical Investors Club. This video is going to be slightly different than some of my other ones. This one's going to be a little bit more macro oriented, but I am going to take a look at JP Morgan stock quickly too. So it would kind of be like a combination video. I saw Jamie Dimon, who's the CEO of JP Morgan, recently made some comments, I think it was today or yesterday, about kind of the state of the recession risk, stagflation, the Fed cutting rates. You can see that I'll put a link to this CNBC article down in the description, but you can see that he thinks the Fed should wait until after June if it was him before cutting rates. Gave a few reasons for that. One was he said they could always cut quickly if they needed to, which is true. And really, he pointed to signs that it's kind of an economic boom still. There's definitely like parts of that you can see in the equity and debt markets. Obviously, the stock market's at all-time highs. The yield curve's still inverted. Long-term rates have come down on government debt. So those markets are trading pretty high. And he said there's probably still a 65% chance of recession, which is so. I like Jamie Dimon because he sounds a lot like me. Like you want to know what the risks are. And I think part of that is because JP Morgan is a cyclical business and I generally focus on cyclical stocks are kind of my specialty. I do a lot more than that, but that's how I started. And so I'm always thinking about like the downside because the downside can be really big with those type of stocks and the risk can be a little bit higher if you're not careful. And JP Morgan is one of those deeply cyclical businesses. And then just bankers in general should, I think, have a cautious demeanor. So I think sometimes people make fun of Jamie because his notes are always kind of citing all these risks, but really you need to be aware of those risks and you might still go ahead and invest go ahead with your strategy. It doesn't mean you just hide under your bed or whatever, but you need to know that those risks are there so you don't get surprised by them when they happen. So let's talk first about the Fed. Inflation, which just came in today, is still high. Even if the Fed got down to 2% inflation by the end of this year, the average would still be like 3% over the past 10 years. And as that rolls forward, if they just kept it at 2%, if they managed to hit their target of 2% inflation, it would be a rolling average of 3% inflation for the next decade as well, because we had so much inflation already. So the Fed is really targeting 3% inflation. And if you're lending money like JP Morgan, I mean, they have a lot of businesses, but they are a bank. They do lend money. If you lend a bunch of money out at 3% and inflation is 3%, the rate is fixed for a long period of time, like a lot of loans are, you don't make any money as a bank. And then there are all sorts of other kind of issues that can arise. So like we saw with the bank failures last year. So because the terms of the debt aren't matching up, right? So I think he's right to be cautious. He's right that these calls for the Fed to lower, well, it used to be March, everybody said, and then I don't know how many rate cuts people thought, 6 or 7 or something this year. There's no evidence that they should do that, except for in certain weaker pockets of the economy, the more cyclical ones, the ones that kind of went bust after the pandemic. We're starting to see it seep into like autos and things like that, where the prices are finally coming down. But it's been a pretty slow process and really only hitting certain pockets of the economy. Service economy is still strong. So, I agree with Jamie, right? I mean, it doesn't make any sense to cut rates when inflation is still over 3%, and the longer it stays over that, the longer the inflation goes on and the longer it stays. So really, to get inflation to 2%, we need to have like deflation, or at least we need to have like 1% inflation for several years in order to average 2%, right? So this is kind of the bind or the trick that the Fed is in. And to me, it seems obvious that minimum inflation is 3% over the next rolling 10 years. And then more likely, Dimon also talked about, geopolitics and things like that. Those things can be inflationary. We could have an energy price spike. That could be inflationary. If we get any of those things to any degree, now we're probably looking at more like 4% inflation. So that people are lending money out, and institutions and businesses that are lending money out at 3 have already lent it out. They aren't doing it now. It's like 8, 9, 10, 11%, to borrow money for real things in the real world now. So on the new stuff, they're getting a good interest rate, but on the old stuff, the longer inflation goes, the worse banks and lenders are going to do. Same with people who are lending money to the federal government for 10 years at 4%, or have already done it for 3%. I mean, they're just underwater, like a 60-40 and things like that. They've just been slaughtered. And I think the main message is that's not going. I mean, traders can trade these bonds, but if you're buying them for like retirement, I just still think it's like bad. Like it's the worst. 10-year treasuries need to be 5% before they even get to like a fair value risk reward. I mean, then if inflation does come in at 3, that's kind of a rosy scenario. You get a couple extra a couple extra percentage points. And if it comes in at 4%, at least you're not losing money by lending that money out to the government. So it makes a lot of sense. I mean, listen to Jamie. A lot of times these risks don't actually materialize, or don't materialize quickly, but they are definitely there even if they don't materialize. So if we look at JP Morgan stock real quick, so I'll make this kind of a stock video along with my just thoughts about I almost missed the stagflation, which was the most important part. He also talked about, we could have stagflation. I think that's a big risk as well. So the best way to deal with that, other than maybe owning some energy, which we've talked about on the channel with Occidental, I think is a good stock to try to balance out a portfolio if you don't have much energy exposure. Other than that, you need to have stocks of quality businesses that can pass those inflation costs on. It's that simple. That's why today in the stock market, after the inflation report came out, you saw all the big tech companies that don't have debt and that can raise prices to whatever they want if inflation goes up, that aren't dependent on credit markets. You saw those all go up, and you saw like utilities and other stocks that do go down. That have less of ability to pass on costs to customers, that have more debt, that are slower growth. Those stocks pretty much went down. So the market isn't being completely irrational, but the flip side of that is the recession risk. And this is where things get really kind of hard for investors, I think. So on one hand, you need to be in these high quality businesses, but everybody already knows that. And so the prices are not cheap, we'll say. But the flip side is if we have a recession, that could hurt everybody, and the stocks trading at the higher valuations, that could hurt them even more. Because then the Fed will, lower rates to try to help deal with the recession, and that will help the lower quality businesses, and then just generally the economy will be slower. There'll be less economic growth, and the Fed could try, over the long term, maybe the Fed will try to balance things out as best they can, but if they're just kind of muddling along, you could get that stagflation thing, but at any time you could get a recession. So I've dubbed this several months ago, maybe it was mid last year or something. I call it fragile stagflation. So we have stagflation that could collapse into a recession at like any time, basically. It's just a matter of if the dominoes start falling. And so what do you do as an investor? Well, what I've been doing is I've been adding more growth-oriented stocks over the past 2 years, and a touch of things that look cheap every now and then if I can find them, but there hasn't been too many. It's mostly the growth stuff. Not all the giant ones. I mean, I already owned Meta. I own ServiceNow. I have Netflix. I have AMD. So I mean, I have some of these that are really have rocketed up, but I haven't been buying them lately. I just already had them. So that's part of the portfolio. I would say like a third of the portfolio are these growth stocks that can hopefully deal with stagflation well. A third are just kind of different things that I found that from different little pockets of the market, or things that I already just owned from buying them in 2020. And then the other third is in short-term treasuries, so cash that's yielding like five. Last time I checked, it was like 5.4%, but it's like between 5% and 5.4% right now. So that cash is in case there's a recession, and in case there's a market that really sends stocks down. And it's been a pretty good balance because I'm not worried about a recession. I've had my kind of recession radar on for a couple of years now. So I don't have really too many stocks in my portfolio that are going to get creamed in a recession, that aren't growth stocks, right? So I don't have too many cyclicals like that I bought that I'm waiting for them to top out. I have like Albemarle I recently bought a couple months ago. That was down at the bottom though, so that's maybe the bottom, but at least a bottom, like 65% off its high. But for the most part, any super economically sensitive stuff, I've gotten rid of all that out of the portfolio. I've gotten rid of almost all the high debt stuff out of the portfolio. So high quality and then cash is pretty much where I'm at, and growth. And that's worked pretty well. Now, it will get hurt during a bear market or a recession or whatever. But having about a third of the money in cash gives me the ability to buy into that weakness so that eventually when there is a recovery, hopefully most of my positions will make it through okay because they're high quality, even if they get hurt temporarily. And then I can buy stuff closer, like cheaper, and then that will really help coming out of whatever recession scenario we might have. So that's the way that I've kind of gone about it. I think generally speaking, the average investor who doesn't monitor like 600 stocks every day like I do, like 50-50 short-term cash, 5% yielding, whatever. And then half in, high quality stocks, is like just a basic way to start. And then the better you are at kind of selecting individual stocks, the more of those you can hold. But if you're doing like ETFs and things, 50-50, the 401k is like about 50-50 now because I can't really pick the individual stocks that I want. And it's been that way for quite a while. So like several months at least, like 6 months at least. Or something close to that. I did have actually a little bit more cash, I think 6 months ago, but at least 4 months. So yeah, it's just, I don't think this is a place where anybody really knows what's going to happen, and things are richly valued. So or at least fully valued. So if you look at JP Morgan stock, it's at a new basically all-time high. It looks like, I think 190 is what I put in my spreadsheet a minute ago. But if you look at historically, it's been very cyclical. Earnings have fallen a lot. They fell a lot here. They fell a lot again coming off of this boom. And the stock price followed those earnings. And so Jamie is wise to be careful because you want to limit those as much as you can. I mean, it's part of doing business, but you don't want to be taken completely off guard and become like the Citibank of 2008 or 9, right? So the way I like to do this is with a high quality. I've never been able to buy JP Morgan because we've never really had a deep recession like 2008 since I started doing this. But if you look at their previous stock price drawdowns, it fell 76% roughly in that 2001 drawdown, right? 70% 2008, 44% in 2020. So for me, if we just had a normal recession, like my prediction or my estimate is like a 60% drawdown, I think a case could be made for maybe getting into it at 50% since it's such high quality. But so yeah, that's basically what I just wait for. There's more that goes into this strategy, but I'm just kind of laying out the basics here. So it's pretty much at an all-time high, so it needs to fall, almost 60% in order for me to buy it. But we've seen that as recently as a couple years ago, it's done that, and we weren't even in a recession, or almost done that. So if we just look at, I'll try to somewhat pick the top here on the fast graph. I will have a 25% off link down in the description if you want to try out the fast graphs service. It's pretty nice for checking some of this stuff. So yeah, almost 40%, probably peak to trough since these are closing prices. It probably was 40 something percent. I think I had 44% drawdown, and that was just like a year and a half ago, right? And that was without a recession. So it doesn't take too much imagination to imagine that if we had a recession, they could fall 50 or 60%. When we didn't even have a recession and they fell 44 or whatever. So yeah, just something to think about. Now the timing of all this, who knows? I mean, so you just have to, I'm not all in one way. I'm just prepared to have the cash if we have a recession and a bear market. And then I have high quality growth for the stagflation, which is the most likely outcome. I'm avoiding high debt businesses, slow growth businesses, or no growth businesses, government, any long-term yield, basically, any long-term like bond. I'm only going short-term and trying to get a return. Now, people will say, well, there's reinvestment risk with that. Yeah, sure, there is. But it's unlikely that the rates are going to come down for very long without there being some sort of reason for it. And right now, inflation is staying high. So the strategy looks pretty good so far. All right, thanks for watching. This was a little bit unusual video for me, but maybe it gives you a little insight to how I'm kind of thinking about things right now. If you enjoyed it, hit the subscribe and like button, and I'll see everybody later.